Hi everyone, in this installment of Take Charge Now, I thought I would talk a little bit about tax planning. The year end is rapidly approaching, and we all know tax planning should really be a year-round initiative, but there are a few things that you can do before the end of the year to put just a little more money back in your pocket. Now, in the interest of disclosure, I am not an accountant. I am a certified financial planner with FP Canada, and tax planning is a legitimate strategy that we should all explore further. We may be leaving some money on the table. Here are just a couple of things to explore. One is tax loss selling. Now, the markets have been extremely volatile and you may have some chronic underperformers in your portfolio. I'm not suggesting because something's been underperforming that you sell it in order to take advantage. From a tax perspective, that may not make sense. But if you have a chronic underperformer you don't think is coming back anytime soon, you may want to take a capital loss. And with that capital loss, you can offset it against capital gains going back 3 years or carry forward indefinitely. But here's the deal. If you're going to do this, you need to do it before December 28th. When you sell a stock, there is typically, and you have to allow for, 3-day settlement. And so the last day for this year, because December 31st is a Saturday, means it's December 28th. Now here's another one, investment fees. Let's say you decide to borrow to invest. That can be tax deductible. Maybe you paid counselor fees on your portfolio when you have non-registered funds. You can gather all those up by December 31st, and there's another opportunity. One that I particularly like surrounds medical expenses. And this is where it makes all kinds of sense to do it as a family initiative. And here's why. When you have medical expenses, you can use any 12-month period, but the amount that you can claim as a non-refundable tax credit will be driven by, to the extent, 3% of net income or $2,479, whichever is less. And this is why the lower income earner should be the one to move forward with this particular claim. And the last one I'm going to touch on has everything to do with charitable donations. Year end, charities need the money. We all know someone who's been hurt, but there's a great opportunity to save money, even though I know no one makes a charitable donation simply for the tax credit. On amounts up to $200, you get a federal tax credit of 15%. To the extent that you exceed that, you can bump it up to 29%, even as high as 33% when you have income over the 200,000 mark. Having said that, you also get a provincial tax credit. Basically what I'm saying is for your charitable donation, you could actually be getting back 54%. And you have until December 31st to do it. And you can wait till the last day if you choose to, because the receipts are electronic. This is not an exhaustive list. There are many opportunities to save money. It's just to get you thinking. When it comes to taxes, think about the 3 Ds. Look for ways to deduct income in 2022 so that you're paying less in taxes. Look for ways to defer it to 2023. Why pay tax this year if you can push it out to next year? Then you have use of your money instead of the government. And look for ways to divide. Think about tax planning from a family perspective, much less so from an individual perspective. There are opportunities to put more money back in your pocket. This is not tax avoidance, it's tax savings.